The buzz surrounding Cava's recent IPO has ignited comparisons to none other than Chipotle, a fast casual heavyweight. With its Mediterranean menu, Cava seems poised to be the potential next Chipotle. But does this assumption even hold water, or are investors just overestimating its prospects? At first glance, the similarities between Cava and Chipotle are striking. Both offer a menu of customizable ingredients. Cava's bowls and pita sandwiches echo the build-your-own burrito model that Chipotle made famous long ago. Both companies also own and operate their own restaurants, rejecting the franchise model typical in fast food. Even the aesthetic choices of Cava's locations resemble Chipotle's industrialist, minimalist design. Walking into both, it might be a surprise to many that with its similar model and its similar look, they're not the same company at all. But let's dive into the numbers, where the real story lies. I'm going to go over a couple of key financial metrics and ratios, but I want to make sure that all of my viewers are well versed on their definitions. Average unit volume, or AUV, represents the average revenue a single store or business location generates over a specific time period. The price to sales ratio compares a company's stock price to its revenue per share. This is gross revenue, indicating how much investors are willing to pay for each dollar of sales. The price to earnings ratio, or PE ratio, measures a company's current share price relative to its profits per share, showing how much investors are willing to pay for each dollar of profits. Chipotle went public in 2006 with 489 restaurants, nearly double Cava's location amount at IPO of 263. And while Cava has been growing rapidly, especially after converting 145 Zoe's Kitchens into Cava restaurants, it's still trying to catch up to Chipotle's early scale. Despite this, Cava's revenue actually exceeded Chipotle's at the time of its IPO. Cava brought in $564 million in 2022, compared to Chipotle's $452 million in the first 3 quarters of 2006. Cava has enjoyed a solid streak of comparable sales growth, which is a positive sign to a young chain. On the unit economic side, Cava's average unit volume sits at an impressive $2.3 million, significantly higher than Chipotle's $1.4 million at the time of its IPO. However, it's important to note that inflation and the rise of digital sales have boosted today's AUVs, which makes it a bit tricky to compare directly. So while these early numbers look promising, there's a key difference between the two companies: profitability. Look, investors are pricing in Cava's stock at a premium. Its price to sales ratio currently stands at 9, a stark contrast to Chipotle's 2 at the time of its IPO. And this makes Cava about 4 times more expensive than Chipotle was at that time. And in fact, Chipotle has never traded at the high valuation levels that Cava currently enjoys. To support that, we can look at Cava's earnings per share, which is only 37 cents, which, with Cava's current share price at roughly $122 at the time of the making of this video, makes its PE, or price to earnings ratio, 331, which is very atypical and is actually the highest figure in its industry. So what does this all mean? There are 2 arguments that can be made out of this figure. The first argument is that Cava stock is overvalued. Investors are paying a huge premium for each dollar in current earnings. The second argument is that Cava's growth expectations are high and the market is pricing in the sentiment that will have explosive growth in revenue, market share, and profitability. It has been 1 year since Cava's IPO, and for comparison, Chipotle's PE ratio 1 year after its IPO was only around 51. This was at a time when no one really anticipated Chipotle to be a giant that it is today. And this may be why there might be such high expectations for Cava. Look at Chipotle's runaway success. Its stock is up more than 3,000% since its IPO and has set an incredibly high bar. Cava's investors are likely hoping for a similar trajectory. Overall, Cava is not doing badly at all as a company. Its revenue in the last quarter grew by 35.2% compared to a year before. It opened 18 new restaurants in that quarter alone. Per unit, restaurants are also showing growth, and their net income in quarter 2, $19.7 million. Compare that to their net income of $6.5 million in quarter 2 2023. So the good thing is that Cava is showing signs of growth. It is going in the right direction. But history has shown that success in fast casual is not guaranteed. Look at Sweetgreen, look at Shake Shack, and look at even Chipotle's own failed attempts at expanding with concepts like Shop House Southeast Asian Kitchen and Tasty Made. These both serve as a reminder that the fast casual market is tough to crack. Cava right now has all the ingredients for success. It has high AUVs, solid restaurant level margins, and a scalable business model. However, at this stage, its stock is priced for perfection, and the risks are higher than some investors may realize. As much as Cava may mirror Chipotle on the surface, it faces a steeper uphill battle due to the lofty investor expectations already baked into its valuation. So for now, while Cava could very well be a long-term winner if it executes its growth strategy, a lot of investors are waiting for a more reasonable stock price before diving into this fast casual phenomenon.